I'm delighted to have Caroline Scott from DFAT Australia, from the Blended Finance Unit there, Mimi Alemayehou, I'm sorry, I should do this in the right order, Meaghan, Mcgrath, Global Head of Partnerships at IFC, Mimi Alemayehou, who is a Senior Advisor at 3 Cairns Group, and Mitch Resnick at Federated Hermes, Head of Fixed Income. And we are going to talk very briefly, I promise. We're going to talk about a couple of things. One is, first of all, DFAT. I wanted to focus on you for a second because we know you fairly well, right? And we know that you've already been existing in a very constrained resource environment for a while. Australia is not an enormous economy. It's a big one, but not enormous, and you don't have a development bank next to you, and you don't have a squad of finance people. You're very conversant in blended finance, but you're working with constraints. So I've seen you go through, I've seen you be very selective in your countries, and I've seen you go through existing partners and existing channels like the Private Infrastructure Development Group. What would you say to your peers today, as they're all looking at a constrained world that, in a sense, you already live in? So what would be your advice to your peers? And let's try to keep it real. You know, if they were sitting here in front of you and suddenly a budget were cut by 30%, what would you tell them to do based on what you've learned?
Thanks, Joan. Thanks, Joan. And congratulations, Convergence. Yeah, that's right. Australia doesn't have a development finance institute, but I'm the director of the Blended Finance and Investor Engagement Unit, and we oversee 3 blended finance mechanisms. And I suppose what we have about $500 million Australian dollars to invest through those mechanisms. And what we try to do is really act at the catalytic stage of the blended finance capital stack. So I suppose our flagship investment is Australian Development Investments, and it's a $250 million impact fund of funds. And that really tries to, in terms of being very targeted with limited resources, that really looks at the missing middle. So it focuses on SMEs in the Indo-Pacific through that. And then we have Australian Climate Finance Partnerships, which is a single donor trust fund managed for us by the ADB. And what that does is try to de-risk investments that the private sector operations department would like to do, but don't meet the metrics that they need for that. So we try and do that with this high impact climate investments available. And then, yes, as you said, we're a co-owner of the Private Infrastructure Development Group, which we try and leverage. And I suppose what's particularly important about PIDG is that it's 6 very like-minded donors. So some of the challenges that are faced in other multilateral groupings, we don't really have. So it means that we really can focus on climate and gender, which are very important. So all of our blended finance mechanisms, they have to contribute to our international development policy. That policy has requirements around 80% of all investments focused on climate and gender. So similarly, all of our blended finance investments are focused on climate and gender. And as you said, our aid policy just focuses on the Indo-Pacific. So all of our investments across South Asia, Southeast Asia, and the Pacific. It's very much not to say that there's not great opportunities and real need in Africa, but our development policy and then our blended finance mechanisms just have to be a bit more targeted than that. And then, as I said, we really try and focus on the catalytic. So we have 3 guiding principles in our investments. First of all, we're impact first. And we have strong development impact has to be built into all of our investment decisions. And we invest early. We want to build markets, be early movers, backing high impact projects and funds while building investee capability. I should say in that also we have a real focus on investing in first-time fund managers and, importantly, female fund managers. So that's a real focus of ADI. And as I said, we want to be catalytic. So we deploy financing to lower risk and give confidence to other investors. And this includes providing first loss, equity guarantees, and concessional lending. So I suppose the benefit of this approach, and advice I would give to maybe other resource-constrained donors, is that while we're not writing the biggest checks, we're seeding high-impact ideas, funds, and projects. And we're really helping to bring in private sector investors as well as DFIs and NDBs. Typically, we invest at the bottom of the capital stack alongside philanthropic capital, and we sort of leverage additional finance that way. And at the moment, Australian Development Investments is mobilising about 5 to 1 in terms of investment.
Thank you. So I've heard you talk about supercharging yourselves in 2 dimensions. One is being early takes less capital to be early, and it's very powerful, and also to be very deep in the capital stack, to be truly subordinate to those who are looking for a better risk and return balance. We're kind of going down into the more commercial spectrum of the capital as we go down the couch here. Meaghan, IFC, Global Partnerships. In a resource-constrained world, what do partnerships look like? How are you going to get more out of blended finance? How do you get more out of less? Is there, what tools, forms, approaches can we expect out of IFC that perhaps other development banks can follow? And you can keep it straight and don't hold your punches if you'd like. And do you have a mic?
Thank you. Happy birthday for 10 years. So it's so interesting what you said, Joan, about imagine, Caroline, that you're talking to donors here and there's been a 30% reduction in ODA. There has been, right? 9% between 2023 and 2024 and another 9 to 17% just this last year. So the reduction is tangible, it's real, and I think we're all thinking about how we do things differently. I see an additional challenge. The additional challenge is the great demographic shift that we are witnessing now. 80% of the population is going to be in what we're now calling developing markets in the next 20 years. And so as we think about where we're going to be making our investments, they're exactly in those places that I think the market is viewing with some trepidation, which is why we're talking about blended finance. So 2 challenges, this demographic shift. Second, the overseas development assistance, the official development assistance going down. But I see 3 opportunities. The third is partnerships. Let me tell you the first 2. The first, I think, is visibility. And Convergence has been so groundbreaking in bringing together thought leaders and practitioners to focus on blended finance, where it's needed, where it's not needed, how it works, how we define it. We might not all agree on the holistic definition, but the fact that we have a view of all the different pieces that are comprised within the ecosystem of blended finance is due to exactly the type of organization that Convergence is and your other corollaries out there, although, again, 10 years in the market, so ahead of most. So visibility, right? Not just all of us, but what the markets bring to offer. And I would say something like the GEMS database, which I know has been referred to earlier, but what it tells us. I mean, the non-performing loans in emerging markets are right there with a single B in the more developed economies. This perception of the additional risk for which blended finance may be needed, I think we need to really address what the risk is. And I know Mitch has some thoughts here too. The third piece is we have visibility, we have data, we have partnerships. So partnerships is all of us in the room, and most importantly, I think, all of us not in the room. So the philanthropies who are thinking about how to use their grant capital differently. The impact investors who are thinking about whether or not emerging markets actually bring the right type of risk to bear. I would say the DFIs who are in the blended finance space with us, but probably need to be more, faster. I mean, let me just double down on what we've all been hearing. What's scalable? How do you get to market? How do you build the projects? I think all of that happens when we come together and perhaps set aside some of the bespoke ways that we've been undertaking blended finance and say, you've got a good idea. How about if we do it your way? Can I come right in line behind you? That is not an easy story to sell internally, but I would challenge ourselves to do that a little bit more, perhaps less innovation. Innovation's important, don't get me wrong, but more standardization, more collaboration, and that's what I think partnerships brings.
Right, thank you. I think this is working now, no? So you mentioned philanthropies doing things differently. That's a wonderful tee up for Mimi. Mimi at 3 Cairns. Again, in an environment of scarcity, and you are a new player on the scene, maybe give us, without, we have to watch the clock, but brief people about what 3 Cairns is. What are you going to be able to do differently because you already watched the rest of us stumble around for 10 years? Not take this one. Mitch,
Is it okay?
Test.
Just maybe a sentence on Three Cairns is a philanthropic investment firm based in New York, and 2 years ago launched Allied Climate Partners, and it launched it as a separate entity and funded it. And it's focused on unlocking climate finance bottlenecks in emerging markets. And we're doing that by anchoring fund managers in emerging markets with catalytic junior equity. And we're not just a very relaxed LP. We actually help them aggregate both junior and senior equity. And I know how difficult it is to fundraise in emerging markets, whether you're looking for junior or senior. I'm looking at my husband here in the front row, who's a fund manager and who struggles fundraising on fundraising. But while we're new, I think one of the things we did a bit differently, and you talked a lot about partnership, and IFC sitting to my right, and IFC is like one of our strongest partners. 2 years ago when we launched, we actually signed an MOU with 7 DFIs, and IFC was one of them. Obviously, they will do their own due diligence on these fund managers, but it was, you don't bring people in at the end after you've selected the fund manager or the investment thesis or whatever. You bring them on early on the journey so that they know what you're trying to build and they can go down the path with you. So it was almost like a co-creation process. So because of that, we've been incredibly successful. I think on yesterday's panel, somebody from Pitch was talking about CSAF, which is our Southeast Asia fund. Just to give you an idea, in 2 years, we have anchored or architected 6 funds, 2 in Southeast Asia, 2 in India, 1 in Africa, 1 in the Caribbean, actually based in Jamaica. And we would not have done it without partners. I think what's different about Allied Climate Partners is that we've been able to aggregate philanthropic capital, I think in a very unique way, that hasn't been done before, and using blended finance to invest in local fund managers. We're very intentional from the beginning that we're going to back fund managers in Africa. They have to be in Africa. The ones in the Caribbean will have to be based in the Caribbean. They will not be based in New York, London, or Paris and doing work there. I think Matt, who lived in Ethiopia, and I met Matt when I was at OPIC like 15 years ago, and I thought he was crazy that he was moving to Ethiopia with his wife, and they had a baby in Ethiopia. Like, I visited her. So, he's been doing the work from the ground. So our fund managers are based locally, and as we're thinking about, with ODA cuts, obviously when we did this 2 years ago, moved into emerging markets, we weren't thinking about ODA cuts happening at the drastic level they were, but thankfully we had this, sort of investment thesis way ahead of that. I think there's a lot of opportunity to really to partner with philanthropies, especially in the climate side. I think a lot of them are doubling down when others are sort of walking away. So I feel a bit more optimistic as I've seen how we've been able to fundraise and mobilize capital, not just on the junior side, on the senior side, from some family offices that will come in on the junior side, but one side of the family office will come in on the senior side. We've seen that happen in the CSAF. We're seeing it happen in the Africa fundraise right now. So I'll stop.
Right, so one thing you've learned is the architecture matters. You built a vehicle that other donors could join in, and then you picked a subject matter that was undercovered, local fund managers, first-time fund managers.
Yeah, just one more addition. I think everybody talked about standardization and trying to get more commercial capital to come in. How do you scale this blended finance? That was the whole investment thesis that got us into this. And I think doing CSAF in Southeast Asia, Project Development Fund, 175 million, has FMO, IFC in it, and senior, right? It was so much easier to talk to those type of junior philanthropy capital, but also the senior capital when we were going to other regions and trying to do something similar in Africa. It was a much easier conversation, and it's a structure that they could understand, LPGP structure as well.
Okay, great. Thank you very much. Mitch, this is the money we're trying to bring in and the skill set we're trying to bring in. Asset managers obviously bring in structuring skills, pricing skills, distribution channels, into the institutional investor world. And you're right now trying to use blended finance and stumbling around with the rest of us. So what institutions do you think might be interesting? What tools, what resources, as a taker and a constructor of, taker of concessional resources, hopefully, and a constructor of transactions? What are you finding useful? What do you plan to do?
Yeah. Test. Microphone 5.
No, take this one. Partnership. Let's constrained resources. We have 2 mics.
So,
Can you hear? No.
it's microphone number
Push the button toward the top end.
Test. There we go. Okay. So first of all, in terms of partnerships, literally this panel, if it worked out, we could do a deal. And also, I feel a little bit like it's a practical joke that I'm on this panel. I'm trying to figure this out just because I have no deal yet or anything. But when you think about the future of blended finance, I think we very much want to be a part of it. In a word, we're a global asset manager. We have public strategies that have sustainability objectives as well as return objectives, and we want to port that into private markets for a myriad of reasons, most particularly that we think direct impact is most applicable there. So I think in sort of pivoting from public to private, basically, the work has been to do like a stakeholder mapping of understanding which institutions, where the expertise is, where the value is, and where they all attach in the value chain. And so when you think about the institutions, for us, we're trying to create effectively a fund that is leaning into origination sharing from development banks or commercial banks. So it's, from a stakeholder point of view, there's an origination partner. There are institutional investors that would maybe take a senior piece. And there's potentially concessionary capital that may or may not take that return enhancing piece if that's the way we decide to go. I'm not convinced yet that necessarily is. And so there's an opportunity for philanthropy there. I think in terms of tools, I mean, look, Convergence is clearly, to jump on the bandwagon, a remarkable job of centralizing an otherwise decentralized market. I come about this from public markets place, and I look at, blended and all this stuff. I'm like, I don't even understand where the center of the market is. I could tell you today what spreads are and what the value is in all the markets that I deal with in credit, but I have no idea in the whole blended world. But so centralizing this decentralized market has been immensely helpful. The data, the transparency. Because when I go to market, like, yeah, but you've never done this before. What do you have? And then I can flip the next deck and show decorrelated risk. I can show I have seen what has worked in the past and what hasn't. These things are immensely helpful.
Thank you. We are not, I don't think, as a community doing that well yet on delivering on data, hardcore data that actually proves ex post outcomes. So we need to provide that. You hear that, demand very clearly from those who are placing institutional money. We're going to do a lightning round, and this is going to test whether you were here today. I'm going to ask each of you very quickly to give me a sense of what you heard over the last couple of days, either here or in the hallway, that you might take with you and apply. Just if you have a rapid fire.
Super quick for us. It's, I think, to make this work for scalability. Everything is about creating something that's optimal. So yes, we need stakeholders, but not too many that's complex. So simplicity, tell a story, be clear about return objectives, be clear about impact objectives, and make sure they're measurable. I loved exactly what you said, you line up the sort of at the design stage, make sure that your partners are all aligned in what you're trying to achieve from both a return point of view and an impact point of view. But don't over yoke the. I don't know what that expression.
No Christmas tree transactions.
Yeah, so
slim them down. Okay.
But there is an element of complexity you need. But I think of like the debt overhang curve. Like debt is good, but up to a point it can kill a company. So
okay.
Yeah.
So design for purpose and don't hang ornaments on the tree that you don't need. All right, Mimi, what did you take away that you might apply? Microphones are fickle here.
It's working now? Okay. I think the last 2 days I've heard in a lot of sessions and in the hallways, people talking about how do we raise local capital in each market. I think Alexia mentioned it in her remarks as well. And we've been grappling about how to do that. Was it pension funds, sovereign wealth funds? In Africa, I think the AFC report said something like 700 billion sitting in insurance and pension funds. And in April, actually, I went to a session moderated by Laurie Springler at Africa conference that FSD Africa put together, and it was a closed session with pension funds from, I think, Nigeria and Ghana, and it was a very honest conversation. I don't think we have those kind of honest conversations from them, like what kind of risk are they trying to, manage, and what kind of shareholders they have, like their government. What will take them, to the other side, and really, really honest. We don't have enough of those. I think we need more of that, because I think untapping and unlocking that kind of capital, even like a small percentage, like 0.5% by next year, would never fill the ODA gap. But I think just working on those kind of targets would be important.
Okay, so there needs to be concerted action on drawing in local capital. Meaghan.
Okay, 3 things. Let me see if I can tie 2 things that I heard. Elizabeth said, policy is hard to be transactional around. And Alexia said, blended finance is it? Sort of. And I think what she was talking about is that it only works when you have the regulatory foundation, which is what Elizabeth is talking about. So we need to remember how much the unsexy work of regulatory foundational work needs to be accomplished so that we can skate on top of that. I think that when we talk about collaboration, the defiant and persistent collaboration, I think that's my motto. I think that's what compels me, and so thank you for articulating it. And the third thing is scale. We just saw the originate to distribute model, and I think this is the way that you leverage. We were, of the 346 projects we committed last year, 78 had blended finance components. That's a good number. But 57 of those 346 we bundled together and we put out in the market, and we put it in a product that can be consumed by institutional investors. And I think that is kind of the future of where we're going. Other ways to scale big, scale fast, and hopefully those will come alongside us.
Thanks. So yesterday, one of the panels discussed trying to mobilise more philanthropic capital, and I really took their advice on board. They were talking about the fact that we need to be very specific about the ask of the foundations and family offices. We need to be clear about how much money we needed, how that would unlock, and what amount of money that would unlock in terms of private capital, with what specific impact. We need to be clear about the specific role of the requested philanthropic capital in the stack, and explain that blended finance isn't used if you could meet the normal risk return sort of profiles for commercial investors. So really being clear about what that philanthropic capital was doing, what it was unlocking. I thought that was really useful advice for me. In our investor engagement work, we convene the International Development Investor Group. So we've got a group of 16 Australian family offices and foundations that are focused on climate and gender, and we try and support them and encourage them to co-invest with us in the Indo-Pacific in that area. We do things like we just did a study tour to Indonesia and Singapore. We're establishing an SPV to try and promote co-investment with us, but I think that really was a good way of sort of encapsulating how you make the case to foundations about how important their capital is.
So there's literally a pitch to be developed by a development agency to talk to a similar kind of capital across the fence in the philanthropic world. That is a lesson. And you and I have worked together somewhat on banging the door of knocking on the door of philanthropic organizations in Australia. Okay, let's think back quickly to how blended finance has evolved in the last 10 years, and then I'm going to make these people make predictions about where we're going. So we know that there's something around $15 billion to about $25 billion of transactions a year that have happened year on year for the past decade. I'm grossly simplifying the data. We know that sub-Saharan Africa outpaces all the other regions. If you look at the number of transactions happening that are blended, not so much the value of the transactions, but the number of the deal count. We know that the median size of blended finance transactions has been climbing. It's slowly climbing. It's at about $65 million median in 2024. So we're getting scaled. There have been these occasional whale transactions popping up, billion-dollar deals. They've emerged, but that has not become a sustained pattern yet. And we know that climate seems to attract everybody. It's the watering hole around which donors gather, as well as institutional money, and all the Europeans worried about Scope 3 emissions. Everybody's interested in climate. It shows up an awful lot in our data. So if we go forward, where do you expect blended finance to play? Do you think it's a tool that a wide variety of stakeholders and sectors will use? Do you think there are certain geographies or themes or types of transactions that are kind of going to bubble up to the top? What's going to graduate and stop being a subject of conversation in this room because it just works out of the box and we don't have to worry about it anymore? Any predictions? And you don't have to answer all those questions, but again, if you just go down the line and anybody has any wild bets about what we'll be talking about or looking at in 10 years, and I'm going to make you go first this time.
Thanks. Well, in terms of the sectors, I don't see a shift away from climate anytime soon because the impacts of climate are only going to be more profound in 2035. I imagine there might be somewhat of a shift away from climate mitigation, although probably some regulatory support will still be needed, sort of for renewable energy. Climate adaptation will be only more immediate and pressing, and particularly for small island states and low-lying, least developed countries. So Australia does a lot of work, has a big focus in our development program on the Pacific. I think focused on climate adaptation will be huge there. It's pretty challenging in the Pacific to do blended finance because private markets are sort of nascent, but definitely sort of some blended finance mechanisms, at least to mobilise more DFIs and MDBs into that. I suppose otherwise, I think we need to broaden the ecosystem. So I spoke before about our work to try and mobilise more philanthropies into the blended finance, particularly in that catalytic space. Leah mentioned before our new NGO accelerator that we're doing with Convergence, really keen to bring them into the system because they really have that local knowledge and that real focus on impact, which I think will be critical. I think from Australia's perspective in particular, because we don't have an DFI at the moment, we really have to look at mobilising a whole range of kind of financing mechanisms. So we don't have a DFI, but our Export Credit Agency doesn't have a development mandate, but it has a mandate to invest in Southeast Asia and it has a mandate to invest in renewable energy. So we've been working with them and trying to leverage our blended finance investments for that much greater capital that Export Finance Australia has. So one example was earlier this year they made a USD 100 million investment into PIDG's Emerging Africa and Asia Infrastructure Fund, and so that's sort of supporting in Asia sustainable infrastructure there. So leveraging those different mechanisms. Also, I think we have to really tap the pension funds. Like I know in Australia there's $4 trillion there for investment in our pension funds, and at the moment only 4% of that is investing in emerging markets. If we want to achieve scale, certainly from Australia's perspective, but I imagine most developed economies, we really have to work out a way to tap those pension funds and build their confidence in investing in emerging markets.
Right, so one of the things you predict then is we draw in more of the parties we need, the local NGOs, your pension funds, and others. Okay, and Meaghan, what would be your wild prediction for the future?
Let me double down on adaptation, because I think that is going to be a key sector where we're going to need to channel our funds. And let me lead into what something I think Mitch might say is, I think we need to look really carefully at where perhaps blended finance is not necessary, so that we can take this scarce resource and put it where we know it's needed. And I think Mimi's shown us the way of, if you're inviting in if you're aggregating the philanthropic investors to come in, maybe they'll come in at the bottom of the stack and then they see the deals and they're coming in at the senior. And I know that there are pension funds, the Dutch pension funds are in, and they're in as commercial co-investors. So I think defining the space of where we actually need to be and really marshalling our resources there and letting the market take care of some of the other spaces would be my prediction.
Push up. There you go.
Okay. I would say the same about adaptation. I think looking at the data that Aisha, talked about yesterday, the Convergence, it's pretty sad how much is going into adaptation resilience. We're also looking to see, what sectors could be investable, almost investable, where blended finance may make sense. Not everything will be commercial. I think hopefully, like in 10 years, we'll be more targeted as well. And then utility scale, solar, renewables, hopefully will be funded 100% commercial. Hopefully we'll not need any blending, hopefully, in 10 years. At the same time, I would love to see more locally led initiatives, African, Asian, Latin American, that would partner with global sort of investors. I think more instruments, somebody said in yesterday's panel, more familiar instruments. I think they were doing something in oceans or fisheries with offtake agreements, which are much more like, I guess, palatable for investors who understand power purchase agreements. I think that, and then, with Convergence, IFC, and others who are, I think IFC just launched your Frontier Fund, which is, using their own balance sheet to do junior. This is a DFI, like, leading the way, so I hope we'll see other DFIs copycat and do more of that.
Thank you. Mitch, what do you hope or think will happen next?
Yeah, so
I think that this the ODA withdrawal is interesting for two reasons. One, and it was a theme today, that it is a catalyst for an acceleration in partnerships between all the stakeholders that are represented here, and that's not necessarily a bad thing. And also will open up investment opportunities. So, and what I hope to see in the future is that, kind of what I seek now, which is a return-enhancing component of a blended fund, won't be needed, because we'll have the information that shows that the perception of risk is wildly off the actual risk, and so the returns are commensurate. I mean, the assets that we're talking about here are uncorrelated with typically what's out there, and the risk-return profiles are good. That is valuable stuff to institutional investors, and that message needs to get out. I think if I had a wish list, I think for me, in terms of scalability, I would love, the funds that we're talking about creating have underlying illiquid assets, and if we could somehow create liquidity facilities to the investor, then you could open up to a whole pool of capital. The private wealth market is massive and substantial, but they need monthly liquidity or quarterly liquidity. So if they're, from an innovation point of view, I would really like to see, and I know that there are some institutions that are out there, but this is something that foundations or philanthropic organizations or development banks might be able to provide as kind of liquidity facilities to make those that are concerned about being locked up, that they're actually not. A little bit the way the insurance, the risk mitigation component provides that bit of confidence to the investors. So that would be my hope. But I think basically this blended finance, I mean, this is the financial ecosystem is not fit for purpose anymore. I mean, fiduciary risk is not comprehensive enough. And I think, blended is a bridge to that new sort of where we need to get to, but it will always need to be there, because even if certain risks are understood and priced appropriately, we bridge that gap, there's still plenty more to sort of jump onto that growth curve.
Right. Okay, thank you. We're going to close a little bit early so that the four people to my left can go off and do a deal. Apparently, they feel like they've got everything it takes. So please give the panelists a round of applause.